in prior sections, we looked at coding. So we're talking about accounts payable, ultimately expenses that wind up on our P&L, which is our profit and loss statement. And by now we know that majority of these expenses that end up on this financial statement have to run through our accounts payable, right? Obviously, there are items that show here that don't run through AP for whatever reason, but a lot of the expenses run through the business office, which is why we spend so much time talking about it, which is why we dive into good controls that should be in place, so that we can make sure that the financial statements are a good representation of the true expenses that we're seeing, which is also why business office leaders are in the best position to be able to speak into the financial statements, because they're seeing majority of this. So this time around, I just want to look at, last time we looked at expenses that were going to hit the P&L, which every now and then you also going to see expenses that may come and have to hit the balance sheet, right? And we call those fixed assets or capital expenditures, right? They're usually bigger in dollar amount, and it's really a big purchase, and there's some special approvals that need to be in place. If you want to run an efficient business office, there are certain approvals that we want to be in place, because it's going to be a bigger outlay of cash, and we just want to make sure that we're spending that money appropriately. So real quick revisit on coding the AP. So we know we get picture invoicing, coding. We've talked about indexing all that information, but just real quick to refresh our memory is we're going to select our geocode. Okay, we're going to put in our amount. Okay, so we review code, going to initiate through the workflow. These are all just things that are going to already be in the accounting system to approve and make sure the invoices are going through. Final approval and post. Okay, and once it's posted, we saw that show up in the P&L. We covered that because we are coding it correctly. We've already talked about if I miscode it, it's going to show up somewhere else, and it can make it harder to identify. Now, what happens if it's a capital expenditure, just like we talked about, something that needs to go on the balance sheet? So that 2,000 hit our P&L, okay, and come back to a bigger P&L just to look at it, because we love to look at the P&L that has several months stacked alongside of each other, because it's better identified trends and whatnot. But if we come here, we see that 2,000 is going to show here in October. Okay, so we're able to really see, if I'm looking at this, we'll say, okay, well, we must have brought on an outsourced accounting firm in September. And so each month I would expect to see a monthly bill there. So again, which is why we like looking at this report, because it allows us to point things out like that. All right, now understand though, there are items that will come through AP that won't show up on our P&L, which means they won't impact our net income, but they're definitely cash that has to come out of our bank account. So it's still an expense in terms of it's still something that we have to pay for, and something that we need to put attention on. A lot of times, a lot of attention is put on the P&L, which definitely makes sense in understanding, okay, net income. But then you wouldn't really have an understanding of, from that net income, what translates over into true cash in the bank, what translates over, and ultimately good health of the business. Because when we cover the revenue, we can build as much as we want. Revenues can be $50,000, but if we're only collecting 25,000, then that other 25,000 cash never makes it to the balance sheet, into our cash account, our bank account, which then allows us to satisfy certain vendors. Let's pretend like we have a capital expenditure, right? We're gonna change the amount a little bit. I'm gonna take that away. It's no longer, forget that. It's no longer an accounting fee. I just want you to be able to see the balance sheet. It's the furniture or something that's coming through that same coding. Let's pretend like Taz is in the furniture business and we buy, or some big machinery. That may be a better example, because when we're talking about capital expenditure, so in these calls, you're going to learn a little bit of accounting, and it's natural because you're in the business office. So this is kind of where we do accounting. which is what we love. But say it's some machinery that you get, right? So it's typically a dollar amount, you know, that we have to exceed, and then it's has a useful life for more than a year. That's what we mean when we say capital expenditure, right? So the company policy may be anything over $1,000 with a useful life more than a year is expenditure that we're going to capture on the balance sheet, not the income statement. Okay, because this is it, once it hits that threshold, we're not hitting the income statement, so we're not going to impact NOI. We're saying that it's going to hit the balance sheet. Okay, so in this case, say we bought some machinery for 3,500 is our amount. We're going to index appropriately. Okay, and we're going to code appropriately. Okay, it's a fixed asset. We don't want to put it on the P&L. Okay, so we don't want to miscode it. So equipment and machinery. Okay, and so we've reviewed invoice, and we like the steps just to try to break everything down into steps. So review, code, initiate invoice workflow, everybody's approval. Boom. This shows here up on that balance sheet. Right? Not going to run it through the profit and loss statement. It doesn't impact NOI, yet it will go in AP, and we're going to have to pay for it with cash. Important to understand that because, again, so much of the focus is put on the P&L, and readers of the financial statements want to be able to understand, yes, we have this much NOI, but what about the expenses that hit the balance sheet, where some of that NOI needs to basically falls off because we've had cash that has to go out for that. Okay, so just know that there's expenses that will run through your business office, and this is why this training is so important, and the support to be able to know that hey, I'm running Community X, and I see these expenses. I know some are going to hit the P&L, but that's not 100% of the expenses. It's majority of my expenses. Right, majority of my expenses will show up on the P&L because we're not going to have, all these capital expenditures run through. We're going to have things like office supplies and postage and insurance, and all that stuff is true expenses that we'll capture in the period. If we're talking about accrual accounting, the supplies and this is senior living focus, so raw foods, like all those are going to hit the P&L majority of that. But just know that when I get here and I say, okay, my total operating expenses, yes, these are total operating expenses, but it's not total expenses in terms of cash is going to go out of the door. And so we have our net operating income of negative $2,300, and then we throw depreciation in there. Know that there's still more expenses, and I'm going to use the word expense, but there's still more cash outlay that hit directly to our balance sheet that has to come out of the bank. Okay. Which is where we get into fixed assets. And so we'll code it. It goes directly to the balance sheet. That's money that's got to go out of the door. But if I'm, running my business office, I want to understand, I want to have a good understanding of not only the expenses that are going to affect NOI, I also want to have an understanding of the expenses that are going to go directly to the balance sheet and impact my cash. And so if I'm having conversations with the property accountant that's handling my building, and they're saying, hey, we're having a little bit of cash challenges, and I'm looking at NOI and I'm saying, hey, well, look, NOI is positive. It'll help close that gap and have an understanding that, hey, nope, there are some expenses that still hit directly to the balance sheet that are draining my cash. And it's like, oh yeah, we just bought furniture for $3,500 or $7,500. That's where the rest of that NOI potentially went to, or just having that understanding is important. So know that when you're recording that, and it typically is going to be, so let's go over here to this chart of accounts over here. You notice the expenses start with 64, right? The chart of accounts can look different way when you're talking about account numbers. So you can have 4 digits in a dash, you can have no dash, but all the expenses you see start with 64. And then our assets are 1,300. It could be 1,200, could be 1,500, but they're going to be represent a different section of the financials. And so anything that's coded to these accounts represent the balance sheet. Anything that coded to here represents the P&L, which I have expense and asset there. And again, all going through the same mechanism, right? We're doing our GL, we're doing all that, and we need to pick here where it needs to go. So homework for you is, what's your CapEx policy? And again, we go back and identify where that may go, right? Like, yep, for our communities, anything over 500, anything over 1,000, anything over 2,000, again, with a useful life more than a year. You work with your accounting team to and interpret that. 'Cause sometimes there could be some gray area, but that's the idea of a capital expenditure that's going to go directly to the balance sheet. Still something that you should be aware of and know. And you see, yep, it's not hitting my P&L, so I report this level of NOI, but it is going to impact my cash, right? And now I see that it is going on the balance sheet. So it's not like, oh, it's not on the P&L, so I don't need to worry about it, right? Know about it and see if you can go find it and be able to just have that level of understanding of where all these, because they have to land somewhere, okay? And allows us to be more focused on where the coding is, you know, and how it rolls to the P&L. So this expense will roll to the P&L, and I'll end it with here. This expense will roll to the P&L in the form of depreciation, right? So fixed assets have to be depreciated. It's probably a term that you've heard about. It's, you know, most times sits at the bottom of the P&L, might not get a lot of attention. You know, your tax team, though, they'll get it, and you know, your accounting team may be making some adjusting entries, but this expense will roll to the profit and loss statement. And my profit and loss statement shows revenue and expenses in the form of depreciation. So what you don't see here, there's a contra account that would show the total depreciation, which is called accumulated depreciation. I promise not to make this sound like a boring accounting course, but just want you to know that when you are coding those balances to the balance sheet, they will roll to the P&L based on what the useful life is for that particular asset category. So say equipment and machinery is 5 years, right? So each year there's going to be depreciation expense over the next 5 years until that's totally gone, right? So you effectively can divide your total amount by, because typically in our industry we're going to do financials monthly, and so we want to show that depreciation expense. Let me go over to the P&L and show how that expense. Forget about the numbers. This is kind of a mock P&L, but that expense is going to show up on our P&L monthly for the next 5 years until the full 3,500 is gone. Okay, so that's how. So ultimately, it does land on the P&L, but that's how the capital expenditures that we purchase, they don't go directly to the P&L. They have to go to the balance sheet, and then if it's a fixed asset, I mean, if it meets the criteria, first it goes to the balance sheet, and then the accounting team typically would make an adjustment to show that in the P&L. So instead of showing the whole 3,500 as a hit on your NOI, you get to show that over the various months. Computers could be only 3 years, so that'll be your 36 months that you will show monthly that expense rolling over to the P&L. But don't be misguided by the fact that we still have to pay for that out of our cash, and that's still coming out of NOI from other periods. So don't be misled by the fact that, hey, it's a capital expenditure and we just can get off our P&L, don't have to worry about it, right? I want you guys to truly have that understanding and know what's impacting your financial statements, both profit and loss and balance sheet, because that brings the picture whole to the whole picture together, because the balance sheet basically reflects the financial position of a company, right? It's going to have my cash, it's going to have my assets and my liabilities, and then it's going to have, get this, all my expenses, but it just reports it in a different way, right? All my expenses and revenue flow through retained earnings or our current earnings, right? Or in our current earnings. So retained earnings would be the accumulated revenues less the expenses for a period for the whole business, right? So if we're talking about October financials, you know, from September all the way since the company existence, that's going to be essentially our revenues less our expenses in that number. And then the current earnings would be the month of October. So put that together, you have your accumulated retained earnings, which is all your revenues and all your expenses. So that's why this financial statement is the financial position of a company, because it has everything. And if I could just bring that point home for you real quick, what I mean by that is, this is what I'm saying, right? So retained earnings is, let's just pretend like it started in January. All our net income, so net income is our revenue less our expenses, all expenses, right? So I'm accumulating that. So if I'm looking at my October balance sheet, I'm going to have retained earnings of every month prior. And then we'll call the current earnings for the current month, which gives us a total of the negative 271. So the financial position of the company, you can see, is at a loss or a negative of 271,000. So the balance sheet is powerful, and you really want to know how to look at it and read it and understand it. And know that the link between the balance sheet and the income statement is retained earnings. But the benefit for you to be able to read that and understand it, when you see the words and you see it show up on your financial statement, you know the link. But also, like we're talking about, colon expenses, is everything is just not captured on the P&L. It's going to go to the balance sheet, and now you know when you're looking at your balance sheet, go look at your balance sheet and look at your retained earnings. You can see since existence how the company has performed. Okay. Let me know if you got any questions. We love questions. Hope that was helpful and just really understanding. Now we've covered all expenses, right? So we've covered expenses that flow through the P&L, utilities and food and supplies and all that stuff. And then those other expenses, those bigger expenses that are going to hit our balance sheet directly. And how does it flow through the P&L? It's going to flow through depreciation. You don't have to know exactly what this is, and we didn't get into the contra accounts, but you do know that it's going to start on my balance sheet, and then by month it's going to flow through my P&L. And so now when you see it, you're like, oh, that's what that is. And that one depreciation line item could be all the assets that you have based on the various useful life. That number is going to show on the P&L as depreciation, and that's how it rolls through to the P&L. So thanks for joining us today. Love getting on these calls and being able to just go over this information. Again, feel free to reach out if there's any questions, if things are unclear. Really want to do a better job of making these videos kind of a snippet, focusing on one thought, if you will, and really just being able to drill down into that. So ultimate goal again is hopefully the financial statements are a little more clear. Tasks that you're doing, you're able to say, oh, okay, that's how that works, right? So next time you see depreciation in P&L, now hey, look, that's the expenses that's slowly working itself from the balance sheet, right? When next time you see that code and it comes through for a computer for a team member, right? Have a new director that comes on, activities director or health and wellness director, have a new director coming on and needs to order a computer. Well, okay, that's a computer that's over our threshold, because now I know I'm going to go find out what my community threshold is. And hope that's $1,500. I know I need to code that to fixed assets, not the same expense accounts that I'm used to coding things to. This needs to hit the balance sheet. So now you know. Awesome. Well, once again, my name is Tatum. I really appreciate you guys. We're here for you. This is what we do. We love to support our business offices with a goal to making sure our business offices are winning through these resources and the education that we're giving. So again, feel free to reach out, ask any questions, and I hope you have a wonderful and productive next week, because we are on Friday. Awesome. Thanks so much.